Build-A-Bear, is it a value investment opportunity? I think so, but here's why. Build-A-Bear is a $470 million market cap company. It is undervalued right now, according to my opinion. Look, it traded almost at $70 just a few months ago. Two other concerns. One is CEO Sharon Price, who has been with Build-A-Bear for over a decade, I think now. She has really transformed this company. She is retiring. There is a succession plan. She's going over to Carter's as the new CEO. So you might want to check that company out. One of the other risks is the cost of goods, the tariffs, but you can see they've had record revenues and also they've been profitable. Build-A-Bear continues to come out with new products, and in their stores, they have a unique, one-of-a-kind experience. Their customer base is diverse, everything from children to young adults to even the older generation. One of the concerns I do have, though, is that their most recent social media posts are not doing as well. Their past social media posts have been a little bit better, but let's just assume that nothing too drastic has changed and they will get it together. Or maybe there's just a lull in the last few days. Before we look at the assets and the liabilities, Berkshire, just remember, if we're thinking about value investing, Berkshire is the gold standard, and they said in 2003 it's per share intrinsic value that counts, not book value. So if we look at the balance sheet, this is book value. You can see that assets, we have 26 million, inventories 82 million, total current assets 142 million, and total assets in general 345 million. So if you think about how the market cap is at 470 and the total assets is at 340, and they don't have any debt, they have operating leases, you have to take into account the intrinsic value. So what is intrinsic value? It is the future earnings of the cash flows. And if we really think about what Build-A-Bear is it just a retail company? Is it just a company at the mall that is going to fluctuate with discretionary income? I really don't think so. I think that they have a customer base that's sticky, that likes the products, the partnerships, and they continue to go to Build-A-Bear. What Build-A-Bear does have to do is really get that technology business down, so the digital is where the real upside is, and they are recruiting for it. We'll see how the new CEO does, but the company repurchases shares. They're really shareholder friendly, and I don't think that that's going to change. And before I forget, I did use Gemini just to tell me so I can share with you some of their profit margins, 55%, operating margins, 12, 13%, and net income margins, 9.5, 10%. And if you want to know what the trailing PE ratio is, 9 to 9.5%, their peers are at around 14, 15%. Enterprise value to EBITDA, 7.1%. You can see a lot is dependent on the technology side and just how the new leadership does and their financial policy. I don't think it's going to change. Let me know what you think.